On July 9, 2026, the United States Treasury sold 30-year debt at a market-cleared yield of 5.058%. That was the highest yield at a 30-year Treasury auction since August 2007. The number was settled in about an hour, in an auction most people have never heard of. And the machine that produced it pulls on your mortgage rate, competes with your savings account, and reprices pension assets across the country. That machine runs on one piece of paper, a bond. Almost nobody can draw what a bond actually is. Let's fix that.
Start with a loan. You hand the government $1,000. In return, it makes you two promises: $50 of interest every year and your $1,000 back after 30 years. Now write those promises down. The amount that comes back at the end, that's the face value, $1,000. The fixed yearly interest payment, that's the coupon, 5%, $50. The date the deal ends, that's the maturity, 30 years. That's a bond, an IOU with 3 numbers stamped on it.
Coupon is literal, by the way. For most of history, a bond was a paper certificate with rows of small, dated tickets printed along its edge. When an interest payment came due, you cut one off and exchanged it for cash. Governments sold these papers to the public to fund wars. The scissors are gone. The word survived.
Here is the feature that turns this IOU into a market. You don't have to wait 30 years. You can sell the paper. The government doesn't care who holds it. The $50 a year goes to whoever owns the certificate. And the instant something can be sold, it has a price that can move. The 3 stamped numbers are frozen. The price is not. Everything else in this story falls out of that gap.
Say you own that bond, and the government starts issuing new ones that pay 6%, $60 a year. Who would pay you a full $1,000 for a $50 a year promise when the same $1,000 now buys $60? Nobody. To sell, you have to cut your price. At about $862, the deal works again. The buyer collects your $50 coupons plus the full $1,000 back at maturity, and on the $862 they paid, that adds up to 6% a year, the same return the new bonds offer.
Run it in reverse. If new bonds pay only 4%, your 5% coupon is suddenly a prize, and buyers bid your paper up to about $1,174. Notice what moved and what didn't. The coupon, fixed. The price, sliding. And the yield, the return a buyer actually earns from the price they pay today, tilting the opposite way. Price down, yield up. Price up, yield down. That isn't a market mood, it's arithmetic, and both ends are bolted to the same plank.
One term to lock in, because it's the number the entire bond market quotes. That all-in return, coupons plus the gain or loss of getting exactly $1,000 back at the end, is called the yield to maturity. When a headline says yields rose, it means this: somewhere, prices fell. And this seesaw is not a niche machine. Add up every bond on Earth, government, corporate, mortgage, and you get roughly $145 trillion. That is more than the value of every stock on the planet combined. U.S. Treasury securities alone are a $31 trillion pile, trading more than $1 trillion every single day. Banks hold them, pension funds hold them, foreign central banks and global funds hold them. When this market reprices, nearly every balance sheet on Earth moves with it. So who decides what the United States pays to borrow? Not the government alone. Back to July 9th. The Treasury announced it wanted to borrow $22 billion for 30 years. Bids came in through 2 doors. Small buyers simply take whatever rate the auction lands on. The big money, funds, banks, dealers, foreign institutions, names its price. I'll lend at 5.0. I'll lend at 5.03. I'll lend, but only at 5.1. Then Treasury sorts every bid. Cheapest money first. Then it fills the order. Cheapest bids first, one after another, until the whole $22 billion is covered.
The last bid needed to fill it draws the line, and by the auction's rules, every winner gets that same rate. On July 9th, nearly $54 billion of bids chased $22 billion of bonds. The bid-to-cover ratio was 2.44, and the line landed at 5.058%. The auction cleared. Demand was there. The honest, market-tested borrowing cost for 30-year money was higher than at any Treasury auction in 19 years.
Within days, you could see that number's relatives everywhere, because the seesaw's yield end is wired into the rest of the economy. A 30-year mortgage is priced off this same machine. Your loan gets pooled with thousands of others into a bond and sold to the very investors who could buy Treasuries instead. So mortgage bonds must pay more than Treasuries to find takers. In mid-July, 10-year Treasury, about 4.6%. Average 30-year mortgage, 6.55. The Treasury rate plus roughly 2 points for the extra risks. When the bottom line rises, the top line usually follows. The same wiring runs everywhere else. Banks compete against Treasury yields for your savings. Companies borrow at a Treasury rate plus a markup. Pension funds sit on stacks of these exact IOUs. One curve underneath everything.
And that is why the seesaw has casualties. Silicon Valley Bank spent the low-rate years pouring its depositors' money into long, safe bonds with coupons locked in near the bottom. Then, rates rose at historic speed. New bonds paid far more, so SVB's old ones slid down the price end of the seesaw. The core securities had not defaulted. Scheduled payments were still arriving. But in March 2023, depositors began pulling their money out, and the bank had to sell $21 billion of those bonds at their new lower market prices, locking in a $1.8 billion loss. That announcement spooked depositors into a full run, and 2 days later, regulators closed the bank. The seesaw is harmless on a whiteboard. It turns dangerous when the person on the sinking end needs cash right now.
So back to that 5.058%. Is it bad news? It depends entirely on which seat you're in. If you hold old bonds, your paper is worth less today. If you're buying new ones, a saver locking in a rate, a pension fund adding fresh assets, you are being paid more to lend than at almost any time in 2 decades. If you're borrowing, a home buyer, a company, the government itself, money costs more. And one honest subtraction. Prices rose about 3.5% over the past year, so a 5% yield keeps only around 1.5% of real purchasing power.
Why did yields rise now? The candidates are real. Heavy government borrowing, inflation that will not settle, shifting bets on the Federal Reserve. Honest people disagree about the mix, and this episode won't pretend to settle it. But the machine itself is no longer a mystery. A bond is a set of fixed promises with a moving price. Price and yield sit on opposite ends of one plank. An auction finds the balance point, and the rest of the economy is built on top of it.